Hi, and welcome to our video edition of Mortgage Watch. I'm Ilan Awerbuch. Many of you may recall that we were producing video editions up to about 6 months ago. We went to an all-print version. Now, due to increased demand of the video version, we're back to offering it to you in a video on YouTube, on our website, and also as a written blog, so you can choose how you'd like to follow along. Well, today's edition is called Extend and Pretend. And that is what commercial regional banks are doing with their commercial loans. They're extending these loans and they're pretending that they're actually paying. We've talked in the past about a lot of the hidden problems that still exist among local and regional banks. That's due to the extreme amount of exposure they have to commercial construction loans and loans that have a tough place of functioning in today's society. A lot of these banks have not yet recognized the losses on these loans, and so they're extending the loans that were due and they're pretending that they're paying. Some of these loans had interest reserve built in, that is, it had the interest payments included, and so the banks are acting as if these loans are doing fine. Nobody wants to recognize losses because it's a bad mark on the bank. But the longer this goes on, of course, the worse it's going to get, and the outcome is going to be worse than it would be if they dealt with it right away. But that's what we're looking at, extend and pretend. What this means is what we're saying, that probably our current crisis is going to go on a lot longer than many people had predicted and most of us had hoped for. On Wednesday, the Federal Reserve Markets Committee came out and left their interest rate outlook unchanged. They're going to be low interest rates for quite a long time to come. On the other hand, the Fed is also going to be continuing to buy mortgage paper into next year. So this had a good effect on the stock market for a while, but then of course people woke up to the reality, which is we're not in a great financial situation and it has not really improved that much yet. There is hope and positive signs on the horizon, but the horizon is probably 9 to 12 months away as a minimum. Today, Friday, the unemployment numbers came out, and as many had expected, they're up. So unemployment has increased. This is not a total surprise, but of course some were hoping that we would have a jobless recovery and we wouldn't need to have really better employment numbers. The truth is, it's never been that we've had an economic recovery without having strong jobs and jobs growth, and at the very least people being rehired to the positions they were laid off in. So because of the weak unemployment numbers, the Federal Reserve saw it coming. They left interest rates unchanged, and they probably will be that way for a while. This is just more of what we've been talking about for about a year and a half now. We continue to roll along. The government is trying to keep things moving. They're trying to institute economic and financial reform, but it's a long and slow and arduous process. So we expect to see ourselves in this situation for 9 months to a year, and perhaps through 2011, 2012, before we really see a turnaround in commercial markets. Next week, I'm going to take a look at how residential loans, negatively amortized neg-am option arms that were made over the past 5 years are performing and how they're affecting the residential market and the mortgage market overall. With that, I wish you a great week and look forward to being in touch with you next week. I'm Ilan Awerbuch for Mortgage Watch.